Slice the Podcast is brought to you by whakapapa, a different way to get a mortgage. whakapapa provides insight and advice so you can make informed decisions for the future of your family. Welcome to Slice, Property Made Possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard.
Welcome back, everyone. Last time we were talking about how to get your deposit together, finding any change we can summon from underneath all the couches in the house. And now we're past that, we're looking forward to rolling into a topic I'm really excited about, the benefits of going in with others. So Amy, if you could maybe give us a little insight as to what we're going to cover today in this one.
Yeah, definitely. So as we spoke last time about going in and getting help and that being the easiest way for each of us to get in, we'll outline a few of the key benefits around why that might be the case. And the first one is lower deposit. So if you put your deposit and someone else's deposit together, you don't need as much to get in and get that 10% or 20% that you require. Yeah. The other piece we'll be talking about is the ability to share costs relating to the property. So whether that's rates or insurance, which are required whether or not you're living there or not, or if you are living in there as well, sharing, the cost of net and power, and also just in general being able to share the loan repayments, because even if you have the deposit, you might not be able to service the loan by yourself.
Very important thing to wrap your head around.
Yeah, so that cost sharing we'll go into a bit of detail on as well, and then there's another couple of points which we'll explain the terminology as well, but one being that we are able to protect our wealth by investing in property from things like inflation. And we're in a high period of inflation now, so we'll touch on that.
Yes, unfortunately.
And then the last point we'll cover off for this episode is around being able to leverage your wealth. It's probably my personal favourite one, because in terms of the rich get rich and the poor get poor, a lot of that comes through your investment power and your purchasing power, which is where going in with others can really help.
Cool. No, nice. I think I heard about 4 separate points there. So
bit to cover.
Bit of turf, bit of ground. So the first one is the low deposit scenario and how to work that to your favour. Can you let us know a little bit about, what you can do, what the strategy could look like there?
Yeah, definitely. I think given we've both done it, it might even be useful to talk about our personal experience with that.
Yeah.
So in my situation, when I purchased with my mum, I had only 40 grand cash as my deposit, and then I secured my loan against her property. So she didn't actually put up any cash, and that's called either a guarantee or a limited guarantee, which we're going to go into some more detail around that in the next episode.
Yes.
But essentially that meant that I could, with a very small deposit, buy a property and buy my first property, and then because I didn't have such an issue with the repayments based on what I was earning, I was able to sort of that part of it out myself. So that's moving into that cost sharing piece.
Yes.
Do you want to touch on kind of what you did for your deposit or repayments as well? I don't actually think I know the detail of it, so I'm excited to hear too.
We haven't had that deep dive yet. Yeah. So I didn't do the guarantor scenario, though I did consider that. So I was really fortunate getting a little bit of help from the bank of mum and dad. So I did save up about 80% of that 20% deposit, and the remaining did come as a loan from dad. My dad did make me sign an agreement. This was not free money. This is on a series schedules of repayments that I'm held to account. But definitely, obviously, helped me get that final foot in the door, right? To make sure I got that 20%.
Absolutely.
That was my scenario.
And that's, I think, something that's not understood is how common these different arrangements are. But if you're doing it for the first time and you're not aware, then going through that detail is really challenging, which is why it's helpful to know about other people's experiences and get the support from the Slice platform and the lawyers on there around what's best for your circumstances to get you to that 10% or 20%. In this current market, it's more likely going to look like that 20% again. And then with the repayments as well, were you you just took those on in the same way that I did? You were able to do that?
Yeah, I was able to service that. No, we
Yeah.
did all this sort of like forecasting as to, you know, if you've got this mortgage from the bank and then a separate loan, so to speak, from Bank of Mum and Dad, can you service that amount? And there was like some leniency, thankfully, from my dad. I understand that the mortgage for a single person paying that is a lot already with the bank. In terms of what I'm having to repay there. But yeah. And then
did you pay interest on that sort of to your dad, or?
Yes, I am paying,
And
interest. It's literally treated like a mortgage.
So you agreed to kind of what that rate might be?
I agreed, yeah. We did the numbers, you know, projected out like 10, 20, 30 years, and then you kind of assume or hope that you're going to have a higher income over time, in which case you should be able to service it more.
And also the equity of your house as well means you can refinance. So we won't go into too much detail on this, but refinancing, it provides an opportunity where since you say you bought your house for, I believe you said 1 million or something around that mark, and then it moved and increased to 1.2, then at that point in time you can reservice the loan based on the new valuation, which means you could actually get rid of that loan with your dad and just increase the amount that you owe the bank. But over time, basically, you hope that the property also increases in value as well as your personal wealth increasing too. So that's, I think, something that's maybe not widely understood, but it's
that's why I have friends like you. You can tell me this information.
Exactly. So you can be able to do that. We're gonna get your dad out of the picture. He's not getting any interest out of you, Deej.
Good to know. Did you hear that, Dad? Take note.
But no, it's definitely an option.
So moving on to part 2 of the
key
takeaways, cost sharing. So
so this is sort of a natural extension of what we're talking about with the deposit there, whether or not you're getting help from a parent or it's, you know, you and your brother going in 50-50 or your friend. Well, the next part that comes with that is if you are buying with someone that's also going to contribute to the repayments, you can obviously benefit from that. So in our particular circumstances, we decided to do the repayments by ourselves, but that's actually pretty challenging for a lot of people. The mortgage repayments can actually be more difficult than kind of getting the deposit together if you want to buy a house of a certain value, i.e. $1 million.
Totally.
So it's something worth considering. Even if you have the deposit, can you realistically afford the repayments? So the repayments calculator we have on the website can support you through, you know, what it looks like if you have to split those up with 4 people. So it might be $360 a week if it's 4 of you at 6% sort of thing, depending on the value of the home. So you've got to consider that. But if you are able to go in with someone else, they actually can take a portion of those repayments off your plate. So, you know, you could end up paying the same as what you're paying for rent, but it's going towards a mortgage and that other person is contributing to that. And then there's some flow-on effects with that as well. Like, I don't know how you sorted this, but I'm assuming it's going to be similar to me, whereby we are responsible as well for the rates, the insurance, the maintenance, and all those kind of all those kind of
things you don't plan for necessarily.
Gnarly costs that come along with that. But if you do have 1 or 3 of you, then again you're splitting, you know, that, and that can be kind of a few grand a year. Like, I think I budget maybe around $6 grand.
5 to 6.
Something like that. So, you know, then it's only $2 grand each if there's 3 of you. And again, once you start living in the property, if you're probably going to have to 9 times out of 10 live with someone else in that property, or rent the property out as you've done, to cover the costs of like living in the home, help with that mortgage anyway, and then also do things like power, net, you know, all of those kind of ancillary costs.
Covered by other tenants.
So if you buy with someone else, then they can kind of take that burden on with you, and you can share those costs and still have, you know, time to have your smashed avocado on toast. The most overused quote that ever was.
It's true though. It's true. We love that. We'll leave that for our Saturdays. Okay, no, that's a really key one. So the one I'm really interested to hear a little bit more about, something that I don't know hell of a lot about myself, is protecting your savings from inflation. You've got a background in sort of the banking world, so you're far more tuned to this topic. This is quite an exciting one for me. I mean, I do, and the purpose of this podcast is to demystify some of those, you know, key learnings that
will impact how you look at buying property and whether or not it's a positive thing. So one of the greatest benefits, I believe, is how property can actually protect your wealth from periods of inflation. So if you have $50,000 today and inflation moves up to 10%, that $50,000 will only be worth $25,000 in 5 years' time.
Wow.
How depressing is that?
It's bleak.
Yeah, so you're saving for your deposit, and then your deposit is worth half the amount that it was, 5 years ago. And we're in high periods of inflation now. So that's the danger with that. But if you move your savings, and that's why, even if you have a small amount, but if you put that together with someone else's and move it into property, you can actually each protect your wealth from inflation, because property historically has outperformed inflation over a 10-year period.
Right.
So that means, as inflation is increasing and the cost of living is increasing, the price of grapes, so random, I'm just really obsessed with grapes at the moment, but that's so expensive. It's so expensive, right, man. Yeah.
It's so sad.
But the cost of that actually just, it gets more and more expensive, and therefore you have to put more and more money in to buy those things. I think a really key point to keep front of mind, and thinking about, I've got a graft and I've got to get to $200,000 and then I can buy a home. Actually, maybe there's a quicker, leaner, meaner way to do that. And that's kind of, we definitely, whilst this podcast is about learning, what that property journey is, no matter how you decide to undertake it, there is a massive focus on fractional ownership and the ability to go in with others to get on the ladder sooner.
But bring clarity to that, because there's a lot of things you need to consider.
But
legal and all that, which we'll cover later.
Which is all kind of part of that platform online, and you can go through that journey. But we'll try and kind of give some of that education in a more conversational format through this podcast as well. But I think, you don't realise that that might be the quickest way for you to get into property. It only actually took me a year to remove the guarantee for my mum off the home loan. So it's like, for 1 year there is a degree of risk that comes with a guarantee, and we'll talk about guarantees more in the next episode. But for that 1 year there was risk, and then I was able to remove that, and I paid her a percentage based fee based on the uplift of that property. So that ended up being about $20,000 that I have to pay off over time. But there's quick ways to go, well, right now I have what I have. Can I get into property today? Can I wait for that to perform better? And then can I get to that state of, now it's my own property? Otherwise you might be, you're just swimming against the tide, especially with inflation, where you're like, I'm just going to keep saving until I get 100K, but that 100K, if you're not investing it, smartly in whatever way, can end up being less than 100K
it's
by
like
the time
money, isn't it? If it's sitting in the bank, which we know rates aren't so good right now.
So the sooner, though, they should get better though in saying that as inflation increases, it tends to encourage the rates on bank accounts. So that should improve some interest there, but still it's just like, the reality is, when you can, this is actually a really good segue into the next point. When you can actually leverage your wealth and invest it. So even if you put, you can put $5,000 into stocks, if you even have that, because at the end of the day, a lot of us need to pay our rent. But the good thing about buying property is you get to move the rent money across to your property. I'm going to more flexible. I'm going to side note here actually, because that's a key takeaway. But if you spend $10,000 a year on rent and you go to uni, you start renting around 18. I did this. After 10 years, that's $100,000 you could have put in or against a mortgage. But of course, you need to get there first. So, but doing that with others is an option. And then even if you did put that $100K into a bank and it was earning 2.5% or whatever it might be, or you might not have enough money to do that. You might only have $5,000 to put into stocks, as I was saying before, or even $500. That's great, and you can make some money. But where the rich get rich and the poor get poorer is they invest with other people's money. And so the really key thing about buying property is it's your first opportunity to take lending from the bank. Even if you're a business owner, like this last business, it's really hard to get lending for that purpose, but the banks do lend for property purchase. So it's the everyday person's best opportunity to leverage someone else's money and invest it. And that's where, I think this is a really good topic, and we'll probably drop into that and consider stocks and property in a later episode. Because there's more detail there, but essentially you can, take your 100K and turn that into 800K. So all of a sudden you've got, 8 times the purchasing power than you had. With your own money. So that ability to leverage and borrow from the bank just means that you're going to get, with that 8 times, if your investment turns positive, you can get 8 times the returns that you would have had with that 100K.
It's crazy, right? It's going back to one of the previous points we made in one of the previous episodes about your mindset on investing. Which, oftentimes it's very safe for a lot of us. Being quite risk averse, but it's just changing your mindset.
I got a lot of questions from people in banks, largely who are used to the system being the system, but saying, I wouldn't want to buy with other people. That's not something that interests me. First of all, they probably didn't need to because they're really high earners. So I'm like, cool, fun for you. But at the end of the day, if that's your way in, to access that part of the economy, that opportunity to invest in property, then that's a great way in, because then you're playing the same game that those really wealthy people are playing, because you're playing with the bank's money, and also you can share the risk as well. So if you and I are going in on a property and then the interest rates are increasing as we're seeing at the moment, well, we're more likely to be able to manage that increase if both of our incomes are going towards that property.
That's right.
So, there's a lot of benefits, but I think we've covered off probably at least 6. We were meant to cover 4. So we might
have to bring more valuable content.
It's a good topic, but we might have to wrap it up. And in the next episode, we'll be looking at guarantees and getting into some detail there. And we will do a whole nother episode on stocks versus property and the different investment strategies and how you can benefit from that as well.
Perfect.
Thank you for joining our community. Buying property isn't easy, but listening in will get you one step closer on your journey. Please leave an Apple or Spotify review and provide feedback so we can improve your experience. Join our Facebook group, A Safe Space to Learn Together, or follow us on Instagram at @slicetobuy. If you have any questions or topics you would like us to touch on, you can email us at hello@slicetobuy.com. A quick reminder, Slice the podcast does not provide personalised investment advice. We are not acting as financial advisors or taking into account your circumstances. To get personalised advice, join us at slicetobuy.com and engage with our partners who can act as your financial advisor or lawyer and support you with your specific needs.